Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. A beginner's guide to international equity ETFs, VXUS, and top alternatives. Investing in international equity ETFs can be a smart way to add global exposure to your portfolio. These funds let you own shares of companies from around the world, making it easier to diversify beyond the US market. For investors looking to balance risk and tap into international growth, these ETFs are a popular choice. VXUS, for example, offers access to thousands of stocks across both developed and emerging markets. Whether you're new to ETFs or thinking about expanding your investments globally, understanding how these funds work is key to making informed decisions. Understanding international equity ETFs. When it comes to building a well-rounded portfolio, international equity ETFs can play a significant role. They provide exposure to global stock markets, helping you diversify beyond US-based investments. But understanding how these ETFs work and what makes them unique is key to using them effectively in your investment strategy. Let's break it down. Definition and purpose. An international equity ETF is a type of exchange-traded fund designed to track the performance of stocks from companies outside the United States. The purpose of these funds is to give investors easy access to global markets, offering diversification that might be hard to achieve by picking individual international stocks. The main difference between international equity ETFs and domestic equity ETFs lies in their focus. While domestic equity ETFs concentrate on US-based companies, international ETFs go beyond borders. This global perspective reduces over-reliance on the US economy and allows for exposure to regions with different growth patterns and risks. Imagine your portfolio being like a buffet. Domestic ETFs give you one type of dish, but international ETFs let you taste cuisines from all around the world. That variety can help balance your investments when certain economies outshine others. Types of international equity ETFs. Not all international equity ETFs are the same. They're designed to cater to different investor goals and preferences based on geographic focus and economic conditions. Here are the main types. Developed markets ETFs. These focus on mature economies, such as those in Europe, Japan, Canada, and Australia. These regions tend to have stable markets, making them less risky but also offering moderate growth potential. Emerging markets ETFs. These target countries with rapidly growing economies like China, India, or Brazil. While they come with higher risk due to political or economic instability, they also offer higher growth opportunities. Think of this category as betting on the up-and-comers of the global economy. Region-specific ETFs. Some ETFs focus on specific areas, like Asia-Pacific, Europe, or Latin America. These are ideal if you have a strong interest or belief in the potential of a particular region. Each of these ETF types allows you to tailor your exposure based on risk tolerance and market preferences. How ETFs are structured. International equity ETFs are built on a core idea, tracking an index. These indices represent a benchmark of stocks from specific countries or regions, like the MSCI All-Country World ex-USA Index or the FTSE All-World ex-US Index. The ETF essentially mirrors the performance of the index by holding the same or similar shares. Here's how these funds typically work. Tracking an index. Most ETFs are passive investments, meaning they aim to replicate, not outperform, the chosen index. This passive approach helps keep costs low, which is a major benefit for investors. Creation and redemption process. ETFs are created and redeemed in large batches called creation units. This process relies on authorized participants, usually big financial institutions, to ensure ETFs trade close to their net asset value, NAV. The structure provides liquidity and transparency for everyday investors. Expense ratios. International equity ETFs typically have slightly higher expense ratios than domestic ETFs. This is due to the added costs of managing foreign investments, such as currency conversion and compliance with international regulations. However, even with these costs, ETFs tend to be more affordable than mutual funds with similar exposure. The structure of ETFs makes them efficient and affordable investing tools. They're like a well-designed highway, built to get you to your financial goals with minimal delays or tolls. By understanding these key aspects of international equity ETFs, you can decide how they fit into your portfolio and investment strategy. Benefits of investing in international equity ETFs. Investing in international equity ETFs can open up new opportunities for your portfolio that domestic-focused options simply can't provide. These funds broaden your exposure, reduce concentration risk, and offer a more balanced approach to wealth management. Let's look at the key benefits that make them an attractive choice for investors. Portfolio diversification. One of the strongest arguments for international equity ETFs is diversification. When you only invest in US stocks, your portfolio is tied to the performance of a single country's economy. That's like putting all your eggs in one basket. International equity ETFs allow you to spread investment risk across multiple countries, economies, and sectors. Broader market exposure. You're not limited to US-centric industries like tech or healthcare. By adding international ETFs, you gain access to sectors that may be thriving in other regions, such as manufacturing in Germany or renewable energy in Scandinavia. Reduce dependency on the US market. Different regions perform well at different times. When one country experiences an economic slowdown, others might see growth, helping to cushion your portfolio. Think of it like creating a playlist. Instead of repeating the same style of music, you mix genres to keep it balanced. Similarly, international ETFs balance your portfolio by including a variety of global assets. Access to emerging and frontier markets. International equity ETFs are a gateway to markets that are often difficult for individual investors to reach. Specifically, they provide exposure to emerging markets, like India or Brazil, and even frontier markets, smaller economies with high growth potential, such as Vietnam or Kenya. High growth potential, emerging and frontier markets are where you'll find economies that are growing faster than more established regions. These areas are often driven by younger populations, urbanization, and increasing consumption. Risk management through diversification. Investing directly in individual companies in these regions can be risky, but an ETF spreads that risk across dozens or even hundreds of stocks. For most investors, the idea of researching and buying individual stocks in foreign countries is overwhelming. Think about currency issues, unfamiliar financial reporting, or political risk. International ETFs do the heavy lifting for you, offering a simple and efficient way to explore these markets without the hassle. Hedge against domestic economic slowdowns. No economy is immune to downturns, and the US market is no exception. Think about how events like recessions, inflation, or geopolitical issues can shake the domestic market. International equity ETFs act as a buffer, helping your portfolio remain stable during these times. Different economic cycles. Every country is at a different stage in its economic cycle. When the US market slows down, countries like China or South Korea might still be on an upward trajectory. Currency diversification. These ETFs also offer exposure to foreign currencies. When the US dollar weakens, holding investments tied to stronger foreign currencies can help balance the impact on your overall portfolio. In simple terms, it's like having a backup plan. If one part of your portfolio struggles, the international side can help keep the overall performance steady. Cost effectiveness and simplicity. Compared to international mutual funds, international ETFs are typically more affordable and user-friendly. For long-term investors, these features can make a significant difference in returns. Lower expense ratios. ETFs often have lower expense ratios because they're passively managed and track an index rather than relying on active management. This translates to less money coming out of your pocket for management fees. Ease of trading. International Equity ETFs trade like stocks, allowing you to buy or sell shares throughout the trading day. In contrast, mutual funds only trade once daily after the market closes. Transparency: most ETFs disclose their holdings daily, giving you a clear picture of where your money is invested. For beginners or experienced investors, international ETFs are a simple way to gain global exposure without getting bogged down by high fees or complicated trading processes. It's similar to buying an all-in-one tool. You get efficiency, versatility, and value in a single package. By understanding these advantages, you can see why international equity ETFs deserve a spot in a well-rounded investment strategy. Key considerations before investing. When investing in international equity ETFs like VXUS, it's important to evaluate factors that could shape your returns. While these funds can diversify your portfolio, they come with risks and costs that require attention. Below, we'll explore key considerations to help you make informed decisions. Currency risk. Currency fluctuations are one of the most overlooked factors when investing internationally. Returns from an international ETF don't just depend on stock performance, they're also affected by exchange rates. For instance, if the US dollar strengthens against foreign currencies, the value of your international investments could shrink even if the stocks performed well. Conversely, a weaker dollar can boost your returns in a different currency. Think of it as needing a translator, not just to understand the language of global markets but also to convert their value back into dollars. Some ETFs attempt to mitigate this risk through currency hedging. These can protect you from exchange rate volatility but often come with added costs. As an investor, ask yourself, is the extra stability worth the higher expense? Understanding how currency risk affects your returns is crucial to managing expectations. That's it for part 1. I hope you've got a good understanding of VXUS and its role in international investing. Stay tuned for part 2, where we'll explore some top alternatives to VXUS and how they compare. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.